A futures contract is an agreement to buy or sell a specific amount of a commodity or financial instrument at a specific price on a specific date in the future. To help you understand why businesses and individuals trade futures, let's examine how futures contracts can be used, the key components that make up a contract, and how much it costs to trade a futures contract. One use of a futures contract is to allow a business or individual to navigate risk and uncertainty. Prices are always changing, but with a futures contract, people can lock in a fixed price to buy or sell at a future date. Locking in a price lessens the risk of being negatively impacted by price change. Let's look at how this might work for businesses, using the coffee industry as an example. If the price of coffee beans goes down, it's good news for coffee shops, but bad news for coffee farmers. However, if the price of coffee beans goes up, the tables turn. With coffee bean futures, both coffee producers and coffee users are able to lock in prices ahead of time. Now, let's look at how this might work for individuals. Say you're looking to buy a new home in a year, and you're afraid interest rates might rise and increase your mortgage payment. You could offset a potential interest rate increase by trading interest rate futures, such as the 30-year U.S. Treasury bond or 10-year Treasury note, depending on your time horizon. A second use of futures contracts is to allow traders to speculate on the price movement of commodities, currencies, stock market indices, and other assets. For example, consider the fluctuations in the price of a commodity like gold. A futures trader can potentially profit by correctly guessing the direction that the price of gold will move. But if the futures trader guesses wrong, he can lose his entire investment and more. Now that you know how a futures contract is used, let's look at 5 key components of a contract. These are also known as standard contract specifications. First, there's trading hours. Futures markets are open virtually 24 hours per day, 6 days per week. However, each product has its own unique trading hours. Next, each contract specifies the tick size. Tick size is the minimum price increment a particular contract can fluctuate. Tick sizes and values vary from contract to contract. A third standard component is contract size. Each commodity or financial instrument has a standardized contract size that doesn't change. For example, one contract of crude oil always represents 1,000 barrels. One contract of gold futures represents 100 troy ounces. And one contract of E-mini S&P 500 futures represents $50 times the price of the S&P 500 index. Another component is contract value, which is also known as notional value. This is the current market value of the commodity represented in a futures contract. To calculate this, multiply the size of the contract by the current price. As you just learned, the E-mini S&P 500 contract is $50 times the price of the index. If the index is quoted at 2,250, the value of one E-mini contract would be $112,500. Finally, there is delivery. Contracts are either financially settled or physically settled. Financially settled futures contracts expire directly into cash at expiration. This includes products like the E-mini S&P 500 index future. Physically settled futures contracts expire directly into the physical commodity. This includes products like crude oil. For example, anyone long a contract in crude oil at expiration will receive 1,000 barrels of crude oil. However, don't be worried about 1,000 barrels showing up at your front door. TD Ameritrade Futures and Forex LLC does not allow clients to take physical delivery. You are required to close the position before the delivery date, and if you don't, it'll be closed for you. You can find more information about contract specifications on the TD Ameritrade website. Now, to understand how much it costs to trade a futures contract, let's look at an example. Suppose a crude oil futures contract is trading at $50. At this price, 1,000 barrels of crude oil would cost $50,000. But a trader doesn't actually have to come up with this amount. With a futures contract, a trader could control the $50,000 worth of crude oil with just a small deposit. This deposit is called the initial margin requirement, and it refers to the minimum amount of funds a trader needs to enter into a futures contract. The initial margin requirement is set by the exchange and subject to change, but in our example, we'll say that to purchase one crude oil futures contract, the trader had to put up $3,000 for margin to control nearly $50,000 in oil. As you can see, Futures can allow you to leverage a relatively small amount of capital to control a larger underlying asset. Because of this leverage, small changes in the price of the underlying asset have a much larger impact on the futures contract. Keep in mind that although leverage allows for strong potential returns, it can also result in significant losses. And if losses are substantial, you will have to add more money to cover losses. Now you know how futures contracts can be used, what the contract specifications are, and how much a futures contract costs. If you're interested in learning more about futures, it's important that you expand your investing education before you make investments. With a little bit of interest and a lot of time, compound interest can help grow a portfolio significantly. Compound interest is reinvesting earned interest back into the principal of an investment. As you reinvest interest on top of interest, your investments can grow exponentially over time. Exponential growth is the result of letting interest compound over time. This idea can be a little abstract, so let's look at a hypothetical scenario to better understand the potential power of compound interest. Suppose there are two investors who have a starting balance of $10,000 each. They both decide to buy the exact same investment on the same date, and they both plan to hold their investments for 30 years. But one investor plans to withdraw the interest at the end of each year, while the other plans to reinvest the interest and let it compound. Let's fast forward 30 years to see the difference in potential returns. In this example, let's suppose that the investment earned 7% per year. The investor withdrawing interest every year would have earned $700 per year. Over 30 years, the earnings would have totaled $21,000. But let's see how much a difference reinvesting the interest could have made. The investor who reinvested the interest would have possibly earned $76,123. This is more than triple the returns of the other investor. This example illustrates the power of compound interest. Now, let's take it to another level and discuss the importance of time. Compounding over a long period of time can potentially lead to significant growth of an investment. Let's look at another hypothetical example to understand how important time is to compounding. Suppose two investors have portfolios worth $100,000 each. The portfolios hold identical investments. Each year, both investors save and invest an additional $10,000. And let's assume that with compounding, their portfolios grow 7% per year. One investor needs the money to retire in 15 years. The other will need the money to retire in 30 years. Let's see what a difference 15 years can make. At the end of 15 years, the investor's portfolio would have grown to $527,193. Now let's see how much the other investor would have earned. As you can see, the additional 15 years of compounding resulted in his portfolio growing to $1,705,833. That's over 3 times the return of the other investor. Now that you understand how time can impact growth, let's discuss 3 ways how you can harness the power of compounding. The first step, and perhaps one of the most important, is to start investing early. The earlier you start, the sooner you can start taking advantage of time. The next step is reinvesting earnings. When it comes to investing, earnings are typically in the form of capital gains and dividends. Some brokers may allow you to automatically reinvest these earnings, or you may choose to simply buy different investments. The final step is to avoid one of the biggest obstacles many investors face: taking excessive risks that can lead to large losses. After all, compounding only works if you're earning on your investments. Of course, always earning a profit is easier said than done because investments sometimes make money and other times lose money. You can't guarantee your investments will make money, but you can avoid taking excessive risks that may lead to large losses. Measures such as allocating your portfolio across different asset classes and diversifying your portfolio within each asset class can help reduce some of the risk in a portfolio. However, asset allocation and diversification do not eliminate the risk of loss. To potentially help avoid large losses, resist the temptations of taking excessive risks or not taking any risk and staying on the sidelines. Because when it comes to compound interest, slow and steady can be a highly effective approach.